Hey, good morning, everyone. Marty Missouri here. It's the 1st of October, 2022, Saturday morning. This is your weekly economic update officially, but I'm going to spend a minimal amount of time there and use the time to talk about some of the underlying dynamics impacting the stock market currently that are getting to some extremes that I think would be good to explore and certainly help you client viewers understand what's behind some of our maybe subtle shift in attitude towards stocks going forward. In front of you is that PWA index. Like I suggested we would, we've really bounced a bit here. We're just barely in negative territory by 2 points. Handful of indicators or inputs to share with you today. We'll start with consumption data came out. Consumers actually spent on a month-over-month basis a little more money, a little more than expected. Continue to look pretty healthy under the surface in terms of their willingness to spend. That is showing up in the savings rate that is dropped. Last month was revised from 5 to 3 and it stayed at 3.5%. So the consumer savings ratio is coming down, so people are saving less of their income, and we presume that they're beginning to draw a bit from that $2 trillion that they have in savings still, and that makes some economists somewhat sanguine about the state of the consumer going forward. And as you know, we are at this juncture somewhat sanguine, all things considered, about the overall health of the consumer going forward. The initial jobless claims is very encouraging, right? I was showing you how this is a dangerous look. These red shaded areas are past recessions. And here we have rolled over now for like the 6th or 7th week in a row, and continuing claims seem to be rolling over as well. Healthy look for the labor market, speaks to the health of the consumer. However, we are hearing a lot of anecdotal evidence, the latest being Facebook, that companies are either beginning to cut or freezing hiring. Still a pretty tight labor market, still keeping the Fed very much engaged in tightening monetary policy. Heavy truck sales actually ramped back up. They revised the last month's number, which was down, and pretty good move there. So that scored positive in our overall index. The economic surprise index for the U.S. continues to go up 18 points. So data is coming in better than economists had expected. And I want to show you the rest of the world here as well. The Eurozone, believe it or not, slightly positive, slightly above zero, slightly better than economists have expected. Japan has shown some really good data here of late relative to expectations, up 37. China is continuing to disappoint consensus expectations, down 29, so fairly negative reading there for China. Emerging markets in general, still negative, still disappointing expectations. Globally, slightly positive. Global economic data seems to be beating expectations on average of late. Let's go back to the China one. I mentioned, I think it was in yesterday's morning blog, that part of our relatively, again, sanguine overall thesis, we do see recession. We do see it as being a mild one. Part of it is the strength of the consumer. The other one is actually the lack of strength in China. Here, I think it's the 16th of this month, is the 20th National Congress. President Xi is going to be anointed for a 3rd term. If you look at what they're doing in Hong Kong, you look at how mum's been pretty much the word lately on COVID-0. You look at yesterday, the government telling various jurisdictions to remove the lower bound on mortgage rates. Essentially, let's let people, first-time home buyers, pay very little in terms of mortgage interest rates. You can see that China is almost daily doing something to fix this situation right here. I suspect the 4th quarter and soon after this meeting, we could see China go big on stimulus. That actually would be globally bullish, probably bullish for stocks globally as well. And when I say globally bullish, I'm referring to the global economy and therefore the U.S. economy. If the yuan, which they're starting to intervene or they're threatening to, were to increase a bit, and that's what the intervention is all about, the dollar comes down, that would be generally bullish, one would think, for the state of U.S. macro conditions and stocks and so forth. PCE, personal consumption expenditures, came out. The headline actually dropped. Headline includes energy and food, but the core actually went up a bit. The core is stickier, so that has the Fed talking tough against inflation, no doubt. But inflation expectations, as illustrated in inflation swap spreads, continues to roll over quite noticeably. And in yesterday's University of Michigan survey, consumer inflation expectations in the short term actually ticked up a little bit, but on a 5-year basis, ticked down. So, the Fed's been concerned about inflation expectations. Certainly market-based expectations are rolling over quite notably. And so actually, let me do a hard stop right there. So there's the data I wanted to share with you on the economy. What we're seeing absolutely fits with our mild recession thesis. That kind of supports our limit to the bear market, which is we're getting pretty close to that. However, when we look across credit markets in the US even, but particularly globally, bad things happen in the UK. Bank of England was forced to step into the UK government securities market basically to save the pension funds from disaster. And those sorts of rumblings are out there. Certain Fed governors like Lael Brainerd, the number 2 in command, seems to be concerned about that and implying that, yes, we need to continue to hike, but we better think about these financial stresses that are growing. Others like Loretta Messer says, to hell with that. Let's get this over with and let's hike like mad. The analogy, I was just talking to a friend a little bit ago, and I said the analogy there is like, we want to get to this destination and we're gonna enter it in a race car going, 100 plus miles an hour. When we get to our destination, well, good chance you're going to crash into a wall. And that's what Lael Brainerd is concerned about. Loretta Messer is kind of, let's go for it. Well, I get it. And frankly, if I may just kind of expand on kind of our view or my view of this, I think you're dealing with egos as much, if not more than anything else. The Fed's credibility is hugely in question. Remember, it was transitory inflation, it's going to come and go. It's all about COVID. It's all about bottlenecks. That was the song the Treasury Secretary had been singing as well. And she has just kind of gone into hiding. I wonder if her job isn't in jeopardy come, post midterms. And so that was the message. Maybe that the Treasury Secretary will be the fall person, for this as well, for really, really missing the mark. So now the Fed has done a complete 180 and said, no, you want to see tough, we'll show you tough. I got to tell you, I think there is just a complete utter lack of rigor in their analysis. And again, I think it's as emotionally driven or ego driven as anything else for some of them. The lack of rigor comes from the missing the mark on what this inflation is all about. Yes, bottlenecks. Yes, pass-through, businesses passing through higher input costs. I get all that. That's all part of inflation. And that actually is the transitory part. The structural part, the part that we've been writing about for 2 years, is all about true deglobalization, right? Globalization is a dirty word, and globalization is a very disinflationary force. It's about populism. It's about this global shift. We've seen it in the US, we've seen it in the UK, we're about to see it in Germany, everywhere, this global shift to when people are hurting, we bail them out. People being the population, the populace. And they're mad. Wealth inequality is at an all-time high, certainly in the US, to the extreme, wealth and income inequality. The political powerful body now is the populace, and therefore populist policies will prevail. And this is kind of a long-term cyclical 40-year cycle. We've come to the end of the capital-friendly cycle, and we're entering a labor-friendly cycle, and that is inflationary by definition. And you're going to have to live with higher, on average, inflation rates. We'll get down to 2% every now and again because of economic factors. The recession, if the Fed keeps going like they are, could be deeper, and we could get there, and they could claim victory amid a whole lot of economic carnage, and their reputation will be indeed mud. And once they figure that out, you're going to see them begin to pivot. So I'm about to show you some statistics that will make you bullish about the stock market going forward. And I want to caveat that going in that no doubt other periods of time when these signals were flashing, you had a Federal Reserve that was worried about what these signals portended and were about to act in a stimulative way. If you believe what they're saying, we ain't there just yet. So our 3,500 price target on the S&P may very well be in some serious jeopardy. Like I said, that was all predicated upon a mild recession. Well, if the Fed keeps going, they're going to force something other than a mild recession. And that, potentially, is going to break something. And financial markets in a reflexive way basically are already guaranteeing that recession is upon us or nearly upon us. And the worse the financial markets get, well, the worse the recession is going to be. So anyway, let's jump into some of that data. So to begin with, just some of our own charts. This is the net short interest on the S&P 500. It actually has come off the boil. So again, it's the difference between the bulls and the bears. Those who are shorting S&P futures versus those who are going long. Still pretty net short. And what that means is that when the market begins to go higher, if it does, that these folks may panic because a short position gets killed when the market goes against them. Also, these are buys that are going to happen. Ultimately, short positions have to be covered, and you covered those by buying. We're seeing the same across other major averages for the U.S. This is the net short interest on the Dow. This is the huge net short interest still on the Russell 2000 small caps. And on the NASDAQ index, which has been holding up in terms of net long, if you can just barely see it there, there's a little speck of red, slightly net short on the NASDAQ finally. Now, let's dig into that look for the S&P. So here's long contracts, right, going up. So actually, believe it or not, here's your contrarian view. At least as of last Tuesday, we had a pickup in traders going long the S&P and quite the fall off in traders who are short. So this is the shorts covering, getting a little nervous. This was ahead of that huge rally, best day in 20 years for the S&P, which we totally took back and some the ensuing 2 days. Pretty rough September start to finish. On the NASDAQ, again, that move to net short was a big jump in NASDAQ short. So while traders in the S&P futures are actually getting a little bit bullish, and as for the NASDAQ, there was a big jump in bearishness. This is people who are joining that doom and gloom party. And this is as of Tuesday. So these folks did really well after Wednesday if they didn't cover all these shorts on Wednesday. So the more short interest we have, right now we're net short on the NASDAQ, the more potential you have later for a pop to the upside if indeed the market moves against those positions. And then two of these indicators I shared with you a week or so ago where I was showing you stress in the credit markets. This is the Treasury volatility. It's kind of the VIX for U.S. Treasuries. You can see it is getting way up there. Here it was in 2008, and here it was when the COVID disaster happened in terms of the lockdown and everything. And so this is stuff that has people thinking, oh my gosh, they're about to break something. Well, if you want to look at what tends to happen, this is the S&P 500. These things tend to happen amid big market sell-offs, but they tend to peak and come down, and then the market takes off. So if we see the MOVE index begin to finally roll over, meaning less stress in credit markets, you're going to see the stock market pop pretty good. But if you, from a pure contrarian standpoint, you say, oof, we must be getting pretty close. I'll say it again, though. Times like this is typically where the Fed is getting very nervous, and the last thing in the world they want to do is come off hawkish, which is exactly what they're doing right now. So there could be more pain here, no doubt about it. And then the Treasury liquidity index, right? When liquidity is poor, this thing gets high. And look, we're not at 2008 yet, but we're certainly pushing the COVID scenario here. Same kind of thing. When this thing peaks, right? Boom, the market tends to do pretty well. So not peaking yet, and the Fed's not implying that they're all that worried about. Some of them are. I believe it was Governor Evans early last week who said a little concerned about overdoing it too soon and breaking something. Lael Brainerd is recognizing that there's some risk here that we need to be careful with. Many of the rest of them don't seem to be. Okay, so now Bespoke Investment Group is one of the handful of firms who we actually pay for their premium research to have access to it. We use different firms for different reasons, different expertise. BCA, we started with them just on geopolitics, but we liked a lot of the other work that they do, variant perceptions and so forth. But Bespoke does this neat stuff where they really dig into the market internals and come up with these, this is what happened going forward when we sat here in the past, so to speak. So market breadth. Remember Wednesday I showed you those graphs of percent of S&P members above the 50-day moving average and above the 200-day, and they're at levels they were when we called the June bottom and said we were ready for a big bear market rally. I said not everything's lining up, so we don't have as much conviction, but it does look like things are primed for that. So in their weekend note, Bespoke talked about the breadth. While the 10-day advanced decline line hit a record low last week, other short-term breadth measures also hit extreme negative readings as a result of the 5 straight days of extremely negative breadth highlighted on the prior page, which we don't need to do. The 5-day advanced decline line dropped to a negative 1977, second lowest reading on record. Okay. Now, the table below lists each time since 1990 when the S&P's 5-day 80 line dropped below negative 1,500 with no other occurrences in the prior 3 months. Forward returns, right? 6 months later, 9 out of the 10 times, the market was higher for an average return of 7% and a median return of 9%. 1 year later, 100% of the time, the market was higher by average of 19%. So again, this is that coming off of all that darkness. Remember, that's been my message this week. Can't find a bull out there, nothing but doom and gloom. Therefore, it is kindling some long dormant bullish nerves because I've been here before and I've seen this play out more than once. The 20-day advanced decline line, okay, hitting an extreme level as well. I'll just go down to the table. When it's been this low historically, this would be the 12th time we've gotten this low. So far, the previous 11 times, 10 of those times, the market was up 6 months later, 16% average, 16% median return. 1 year later, one down year, 2001, average 27%, median 24%. Now, this is pretty compelling stuff. This would tell you, indeed, we should be putting some of the new money that's come into work and to add some of the liquidity that we've been holding on to at these lower levels. Will we do a little bit of that in the coming weeks? We may very well, particularly with the brand new money that's come in. One other thing from Bespoke, and then I'll let you go. They do a daily sector snapshot, and they have their own overbought, oversold readings, has to do with standard deviations away from a 20-period moving average, yada, yada. So anyway, here is this area right in here I want to point to, right there, the overbought, oversold readings, and this is sector by sector. First of all, the S&P is at historically extreme oversold readings, okay? You notice how they color that in green because the markets and the sectors tend to pop off of extreme oversold readings. So folks, we are entering the best quarter of the year in the most oversold positions in all but healthcare and energy, as you can imagine, right? So again, a contrarian should be feeling uber bullish right here for the go forward in the very short run anyway, okay? But we're still in downtrends, right? We're not out of this bear market. It may be further than we think to the downside. We'll be very careful with that downside target of ours. But folks, here's the thing. The bottom is going to be formed amid utter extreme pessimism, extreme oversold nature, and it's going to be something that people just don't expect. That's the nature of these things typically. It's that whole darkest before the dawn. However, I'll say it for the umpteenth time, that Federal Reserve and the inflation prints is what could keep this thing really ugly for a while. We've got jobs numbers next Friday. They're seeing inflation roll over in many areas. It should start showing up in the data, but there is some really sticky inflation going on. And, when we have rising wages and a tight labor market, you know that you're going to have inflation hold up to perhaps an uncomfortable degree going forward. We are going to see some interesting things around the Christmas season. I got an email from Dick's Sporting Goods. A whole bunch of their stuff is 70% off. We know that inventories are up, so you're going to see, at least in that retail space, there's probably going to be some pretty big bargains showing up between here and Christmas time, which should reflect to some extent in the inflation data as well. So I'll stop rambling there. Really important stuff to get our heads around relative to both the short and the long-term dynamics around stocks. From a contrarian perspective, it's a good setup for the short run right here. However, those readings coming from the credit market are concerning, and something could break and we could see some waterfall sell-off to the downside. I think it's reasonable to say we're closer to the bottom than the top, if not from a pricing standpoint, certainly from a timing standpoint, if we can look at it that way as well. Folks, thank you as always for watching and listening. Hope you have a great weekend. Talk to you next week. Bye-bye.